Hello everyone, I am Dr.A.G.Mythili, Assistant Professor, Department of Commerce with Finance, Dr. SNS College of Arts and Science. I am going to speak about risk management in this video. Risk management. What is risk management? Risk management is the process of identifying, evaluating, and controlling potential risks in order to protect an individual financial well-being. Risk management in the context of personal financial planning entails identifying potential risk, assessing the livelihood and potential consequences of each risk, and creating plan to control or lessen those risks. The protection of a person's financial assets and source of income is the main objective of risk management in personal financial planning. This could entail taking action like getting insurance, diversifying investment holdings, setting up an emergency fund, or making a contingency plan for unforeseen future. Now coming to the objectives of risk management. It protects assets. The primary objective of risk management in personal financial planning is to protect an individual financial asset from potential losses due to unexpected events such as job loss, disability, illness, death, or investment loss. Minimizing risk exposure. If effective risk management aims to identify potential risks to develop strategies to manage or mitigate those risks, thereby minimizing an individual exposure to financial risk. Maintaining stability. Risk management in personal financial planning helps individual to maintain financial stability even in the face of unexpected events or economic downturns. Achieving financial goals. By minimizing financial risk and protecting financial assets, risk management in personal financial planning helps individuals to achieve their long-term financial goals such as saving for retirement or paying for education. Enhancing resistance. Effective risk management in personal financial planning can enhance an individual financial resistance, allowing them to bounce back from unexpected events and recover more quickly from financial setbacks. Reducing stress. By minimizing financial risk and protecting financial assets, risk management in personal financial planning can reduce stress and anxiety related to financial uncertainty. Improving decision making. Effective risk management can improve an individual decision making by providing a more complete picture of their financial situation and potential risk, providing peace of mind. Effective risk management can provide individuals with peace of mind knowing that they have taken steps to protect their financial assets and achieve their long-term financial goals. What are all the different types of investment risk? There are about two types of risk. One is systematic and the other one is unsystematic. Systematic risk are within the entire system. This is a kind of risk that applies to an entire market or market segments. All investments are affected by this risk. For example, a risk of government collapse, risk of war or inflations. Such risk will affect wholly. It cannot be completely diversified. It is also known as undiversifiable risk or market risk. Unsystematic risk is also known as residual risk, specific risk, or diversifiable risk. It is unique to a company or a particular industry. For example, strikes, lawsuits, and even such specific to a company can be diversified, awayed by other investment in your portfolio. There are different risks available. Credit risk, and then country risk, political risk and reinvestment risk, interest rate risk, foreign exchange risk, inflation risk, market risk. are some of the risks faced by all companies. So political risk. This is higher in emerging economies. It is the risk that a country's government will suddenly change its policies. For example, today, the continuing reigning debate in FDI in retail, India's policies will not looking very attractive to foreign investors. So the stock prices are negatively affected. Reinvestment risk. This is a risk that you look into high yielding fixed deposits or corporate deposits at a highest available rate. So interest rate risk. A golden rule in debt investing: in interest rate goes up, price of bond goes down, and vice versa. So for example, in our situation today, we appear to be at an interest rate peak. So foreign exchange risk. Forex risk applies to an financial instrument that are denoted in a currency other than your own. For example, if a UK firm has invested in India and the Indian investment does not well in rupee term, the UK firm might still lose money because the rupee has depreciated against the pound. So when the firm decides to pull out the investment on maturity, it gets fewer pounds on redemption. With the recent very sharp fall in the rupee, the forex risk of our country is as an investment designations have increased. Inflation risk. Inflation risk or simply inflation risk, and when it is real return on your investment is reduced due to inflation eroding the purchasing power of your funds by the time of mature. Market risk. This is the risk when the value of your investment will fall due to market risk factors, which include equity risk, that is risk of stock market prices or volatility changing, interest rate risk, currency risk, and commodity risk. These are all the some of the types of risk faced by the companies.